This is an introduction to investing in bonds. We're going to expound on the concepts that we've gone over in Introduction to Investing, where I gave you a brief definition of what a bond was. I'm going to show you different types of bonds, from corporate bonds to government bonds, some characteristics of bonds, and towards the end, I'm actually going to show you a equation, which we're not going to go into too much detail in because it's very complex, to basically value a bond. And from there, we're going to go on to a class in mutual funds, which is after this one. With that being said, let's get started. What is a bond? A bond is a long-term debt security issued by a government agency, or corporations. You've heard me say par value a lot in several other slides, but here's the exact definition. Par value is the amount returned to an investor when a bond matures. So if you bought a bond at $9,500 and when it matures you get $10,000 back, the par value of that bond is $10,000. A characteristic of a bond, bonds have call features, which is the ability for an institution to recall a bond. An example, let's say for instance you had a bond that had a coupon rate of 14%, but the company is now doing much better financially, so they can afford to give out bonds with interest of 7% with a coupon rate as opposed to the 14% that you got. They can pull that bond back. And why would they do that? Of course, because financing is cheaper on a coupon rate of 7% as opposed to a coupon rate of 14%. You also have convertible bonds, which in essence is just a bond that can turn into shares. And again, you know what shares are now from the previous couple of courses or classes, which is partial ownership in the company. And if you have the assumption that a company's shares are going to increase in value, it could be more profitable for you to increase or to convert the bonds into shares. There's ups and downs to it, obviously. It could be more profitable in the event that you're converting to shares, but the downside is that there's lower yields on a convertible bond. Because you have that possibility of converting, if in the event the share prices don't go up, the yields on that particular bond are going to be cheaper than a bond that's not convertible. And another concept, yield to maturity, which is the annualized return on a bond until maturity. Here's a quick snapshot of a calculator. You can find this particular calculator on AOL.com, calculators.aol.com. There's a bunch of calculators that you can use for any number of these things. You don't need to know all of the equations. You just need to know the inputs to try to figure out your returns. Here you have face value, coupon rate, months to maturity. You can add all of these this information, and at the bottom you click on next, which goes to your results to show you all the information that you're looking for from those inputs. Again, there are different types of bonds. There's government bonds, government agency bonds, and corporate bonds. These three are under the section of government and government agency bonds. Treasury bonds are debt securities issued by the U.S. Treasury. Municipal bonds are debt securities issued by state and local governments. Interest earned on municipal bonds is tax exempt, so that's cool. Let's say, for instance, you had a choice between investing in a treasury bond and investing in a municipal bond that earned the same amount of interest on your investment. Your treasury bond is going to be taxed, and your municipal bond is not going to be taxed on the interest that's earned on it. So essentially, you make out better with investing in the municipal bond as opposed to investing in a treasury bond, simply because you don't have to incur taxes on those interest rates. Now, of course, treasury bonds are considered to be default risk-free, where municipal bonds, although are unlikely to default, still have some default risks to them. Municipal bonds typically offer more interest So either way you look at it, you're kind of making out better with the return, if it doesn't default, of course. And a federal agency bond are debt securities issued by federal agencies like Fannie Mae or the Veterans Administration or the Housing Administration, Federal Housing Administration, and so forth. There's corporate bonds, which are debt securities issued by large firms. And within corporate bonds, you have high yield bonds or junk bonds, which are bonds that are issued by less stable firms that offer a high rate of return simply because they have a high degree of default risk. They haven't proven themselves financially yet. And in one of the next slides, I'm actually going to show you bond ratings and how to analyze whether or not a bond is going to default or not default based on its ratings. Default risk comes with any type of investment that you have. A default risk can be offset with a risk premium, which is the extra yield or the extra interest required to compensate for the amount of risk. So let's say, for instance, I know that $1,000 that I invest in John, I'm going to get back for certain. So I may tell John I only want 4% interest on that $1,000 investment. So John's the standard then for no default for me in my life. And let's say I have $1,000 that Jacob wants to borrow, but I know that Jacob's likely to default. So I may tell Jacob, hey, I want my $1,000 back plus 50% interest. An outrageous example, but I want my $1,000 back plus 50% interest. So Jacob has to give me $1,500 back. The difference between the no default interest and the high-end default rate risk that I have is called the risk premium. So that 50% that Jacob has to pay as opposed to the 4% that John has to pay, that 46% difference would be considered the risk premium. Below, Standards & Poor's and Moody's are the two leading industry standards of grading for the investments. And you can see here you have AAA, AA, A, BBB, all the way down to D. And it's giving you a grade here, what it means in terms of potential defaults in investments. You can pause for a second to go through that in more detail if you haven't been looking at it, because I've been talking on this slide for a long time. There's other type of investment risks. There's call risk, which stated earlier there's a call option that bonds have. In the event that there's a chance that the bond will be recalled in exchange for bonds with lower coupon payments, because it makes it cheaper for the company to receive financing, a really good coupon rate that you got on a particular bond, who has now become essentially default risk free. You no longer can hold on to that because the company is now going to recall that particular bond. Another type of investment risk is interest risk, which means that if the interest in the industry goes up, say to 10% as opposed to 7% when you were holding a bond, the value of your bond becomes less valuable because people now know that they can get a bond with 10% coupon or interest rates as opposed to your 7%. So to offset that loss that they would get for buying into your 7% coupon rated bond, they would buy it for less than it was actually worth when you initially bought it. So let's say, for instance, you bought it for $1,000, 7% interest, and now you can get $1,000 with 10% interest. They might buy it for $750 or $800 as opposed to $1,000, so that they can make up for that loss in interest that they could get from another bond. Here's a quick food for thought. The impact of bonds maturity on interest rate risk. Let's say, for instance, you owned two bonds with a par value of $10,000 with interest of 10%. One was held for 2 years, the other one has a maturity date of 15 years. And the interest rates in the industry shrank to 8%. Which one becomes more valuable to you? Obviously, the one that takes a longer time to mature would be the more valuable one, because while everybody else is receiving 8% interest, you're now still receiving 10% interest over the next 15 years, as opposed to just 2 years of 10% over the standard 8% in the industry. Investment strategies. There's 3 that you can look at when you're investing in bonds. The first is interest rate strategy, which is simply forecasting the future expectation of interest rates and the bond market, and selecting bonds accordingly in terms of maturity and whatnot. There's also a passive strategy, which is investing in a diversified portfolio that's held for a long period of time. With that being said, even if there's a rapid change in interest rates, you're not really being hit by it too much because you're very diversified. There's also matching strategy, which is investing in bonds that will generate payments to match your future expenses. What that means, let's say that you have kids that are going off to college in the next 20 years or the next 10 years, or you plan on retiring soon. You may want to generate coupon payments or income payments from those coupons that can cover those expenses that you could have for colleges or retirement or whatnot. This is the end of investments in bonds. Again, we're going to go on to a course in investing in mutual funds. There's 2 standard type of mutual funds that you're going to be looking at, stock mutual funds and bond mutual funds. We're going to talk more about that in the next class. Thanks for listening in. I look forward to seeing you all and continue getting good feedback from you all from watching these videos. Take care. Here's a quick add-on. This is the equation that I'm investing in bonds. This is how you find a bond price. Quick example. I'm not going to get in too much detail on this particular equation, but let's say, for instance, the industry standard has gone up to 12% as opposed to the 10% that someone was holding a bond at. In order to find out how you could compensate that loss of that 12% interest on the new market standard by investing in that bond that has only 10% or 10% coupon rate, you would use this equation. Just off the top of my head, let's say that the par value of the investment's $1,000 with 10% interest, and the new market standard of the par value of $1,000 is 12% interest, with a maturity rate of about 10 years. In order for you to buy that coupon or that bond with the coupon rate of 10% as opposed to 12%, you may buy that bond for only $895 as opposed to $1,000, so that you could get that yield, which is 12% compared to the industry standard. With that being said, that's officially the end of investing in bonds.